Hello, dear traders. Just a few days ago, the oil market was under intense geopolitical pressure. Following the exchange of strikes between the United States, Israel, and Iran, traders began seriously pricing in the possibility of the Strait of Hormuz being closed, a road through which roughly one-fifth of the world's seaborne oil exports pass. Against that backdrop, WTI crude surged above 100 per barrel from February and March until May 2026. However, the situation has gradually begun to change. Despite increasingly aggressive rhetoric from all sides, the market has shifted its focus away from political statements and toward the actual probability of a disruption in physical oil supplies. Several important developments have emerged. First, Oman, which has traditionally acted as a mediator between the United States and Iran, made it clear that it does not support closing the Strait of Hormuz and remains committed to keeping shipping lanes open. This proved to be a significant signal for the market, as it showed that even countries in the region have little interest in disrupting global oil flows. Second, Donald Trump stated that the Strait of Hormuz would remain open regardless of Iran's position, and even suggested that the United States could become the guardian of Hormuz, charging fees for ensuring the security of maritime traffic. Iran responded by declaring that it would never allow the US to control the strait and warned of a strong response should Washington attempt to intervene. This creates a rather unusual situation. Political rhetoric continues to escalate, yet oil prices are moving in the opposite direction, gradually losing their geopolitical risk premium. Investors increasingly believe that as long as tankers continue to transit the Strait of Hormuz, the risk of a full-scale energy crisis remains limited. This shift is also clearly visible on the chart. So, after a sharp correction, buyers managed to push prices back after closing gaps and near the price 67.70. And the market is now testing the important resistance zone between 74 and 75. This area represents one of the most significant high volume trading zones established over the past several months. As long as oil remains below this resistance, it is still too early to talk about the return of a sustained bullish trend. However, a decisive breakout above 75 could open their way toward the next major resistance area around 86. On the other hand, if geopolitical tensions continue to ease while physical oil supplies remain uninterrupted, the market may continue trading within a broad range, gradually unwinding the geopolitical risk premium that had previously been built into prices.